Most investors think they're playing it safe with SCHD. But what if that safety is quietly costing them hundreds of thousands in long-term growth? In this video, I'll show you 4 smart pairings that fix the gaps without sacrificing income. You clicked because SCHD isn't enough. And you're right. It's solid, but it leaves major growth on the table. So what do you pair with SCHD to boost returns without killing your dividends? And more importantly, which combo fits your goals best? Income now, long-term growth, or something in between? In this video, I'll break down the 4 smartest ETF pairings to fix SCHD's blind spots. And I've made sure each one fits a different investor profile, so you can act today, not just someday. SCHD is one of the most trusted ETFs out there, but even the best tools have limitations most investors never see coming. Let's start with what makes SCHD so popular. It offers a 3.5% dividend yield, has increased its payout for 13 straight years, and charges only a 0.06% expense ratio. It's the gold standard for income-focused investors. But here's the catch. SCHD leaves out companies that don't have long dividend histories. That means zero exposure to explosive tech giants like Nvidia, Amazon, Apple, and even Meta. These are companies that have driven much of the market's growth over the last decade, but SCHD skips them entirely. From 2013 to 2023, that decision had a real cost. SCHD underperformed broader growth indexes like the NASDAQ 100. Even just a 2 to 3% difference in annual return might sound small, but over 20 or 30 years, that adds up to hundreds of thousands of dollars. It could be the difference between retiring at 60 or 50. This isn't about abandoning SCHD. It's about fixing the blind spots without breaking what already works. If you only hold SCHD, you're missing out on key sectors, especially tech, and that could quietly drag down your long-term returns. But here's the good news. With the right ETF pairings, you can plug those gaps and unlock much more wealth without giving up your income stream. What if you could inject long-term tech growth into your SCHD portfolio without duplicating a single holding? SCHG, the Schwab US Large Cap Growth ETF, is everything SCHD isn't. It's built for growth, not dividends, and that's exactly why it works so well alongside SCHD. Here's why. SCHG shares 0% of its holdings with SCHD. That means when you add it, you're not just doubling down, you're truly diversifying. And the holdings are pure firepower. Apple, Nvidia, Microsoft, Amazon, and Meta make up about 40% of the fund. These 5 stocks alone have driven much of the S&P 500's returns in the past decade. The performance? Over the past 5 years, SCHG returned more than 20% annually. Over 10 years, it averaged nearly 16% per year. Those are numbers SCHD simply can't touch because SCHD was never designed for that kind of growth. Now, let's talk about cost. SCHG's expense ratio is only 0.04%, which is even lower than SCHD's. But don't expect much in terms of yield. At just 0.4%, this ETF is all about capital appreciation. A 50-50 barbell strategy, half SCHD, half SCHG, gives you both steady cash flow and explosive upside. You don't need to time the market. You don't need to pick stocks. You just need to balance growth with income, and this combo does exactly that. If you thought SCHG was powerful, just wait. Coming up is the ETF that pays you every month, without giving up long-term stability. And at the end of this video, I'll reveal which pairing is best based on your financial goals. What if you could plug SCHD's gaps without sacrificing yield or taking on new risk? Enter VOO, Vanguard's S&P 500 ETF. It's not flashy, but it's one of the most powerful tools you can add to a dividend-focused portfolio. VOO tracks the entire S&P 500, giving you broad exposure to every major sector, including the tech names SCHD skips. But what makes it a smart SCHD partner is its low overlap. Only about 7% of its holdings are the same. That means when you add VOO, you're actually getting new exposure, not just duplicating what you already own. It's also incredibly efficient. With a 0.03% expense ratio, it's one of the cheapest ETFs on the market. And while it's not a dividend monster, it still delivers a modest yield. If you split your portfolio 50-50 between SCHD and VOO, you'll land somewhere above 2% in yield, which is still strong compared to many portfolios that chase growth alone. The numbers back it up. If you had invested $10,000 in SCHD and $10,000 in VOO 10 years ago, you'd be sitting on more than $61,000 today. That's steady, market-matching growth without going all in on any one sector or style. If you want a portfolio that covers both income and market-wide growth, VOO is your missing piece. It fills in SCHD's blind spots while keeping your risk low and your costs even lower. What if your investments could pay you every month without chasing risky high-yield stocks? Meet JEPI, the JP Morgan Equity Premium Income ETF. Unlike traditional ETFs, JEPI uses a covered call strategy to generate income, collecting option premiums on top of dividends. That results in a massive 7.9% yield, paid out monthly. For investors who want cash now, not 20 years from now, this can be a game changer. JEPI holds 129 stocks across tech, healthcare, financials, and more. And the overlap with SCHD? Just about 8%, meaning it adds real diversification to your portfolio. But here's the trade-off. JEPI's upside is capped in strong bull markets because of the covered calls. You won't see the same massive capital appreciation you might get from SCHG or VOO, but in return, you get consistent monthly cash flow, even during market turbulence. If you're aiming for monthly income while still wanting diversified exposure and reduced volatility, JEPI is one of the strongest pairings for SCHD. Together, they create a hybrid portfolio that delivers both reliability and results, without depending on luck or perfect timing. SCHD gives you income, but what if you also want that income to grow every year, no matter what the market does? That's where DGRO, the iShares Core Dividend Growth ETF, comes in. It focuses on companies that don't just pay dividends, they increase them consistently. DGRO requires its holdings to have at least 5 years of consecutive dividend growth, which opens the door to more companies than SCHD's stricter rules. That means more exposure to younger, fast-improving dividend payers. It's also widely diversified, with over 400 holdings across the market, and carries a modest 0.08% expense ratio. While there is about 16% overlap with SCHD, the strategy and sector spread make it more of a complement than a duplicate. DGRO offers a current yield around 2.1%, but its real strength lies in dividend growth. Many of its top holdings, like Microsoft, Visa, and Johnson & Johnson, have been steadily raising their payouts year after year. And in terms of performance, DGRO has slightly outpaced SCHD over the last 10 years. That's a big deal when you're building for long-term stability and rising income. If your goal is a portfolio that not only pays you now, but pays you more every year, DGRO is the upgrade you've been missing. Paired with SCHD, it creates a dividend engine that grows with you through inflation, recession, and everything in between. Now that you've seen all 4 ETF pairings, the only question left is, which one fits you? SCHD is still one of the most reliable foundations in dividend investing. But when you pair it with a second ETF tailored to your goals, you don't just diversify, you upgrade your entire financial outcome. Here's how to decide. If you're already retired or nearing retirement and need consistent monthly income, JEPI is built for you. It turns your portfolio into a reliable paycheck, even in sideways markets. If you're in your 30s or 40s, still building wealth and want access to explosive growth, pair SCHD with SCHG. It brings in the tech exposure SCHD lacks and captures long-term upside. If you want broad exposure across all sectors and a low-maintenance approach, VOO is ideal. Especially great for investors who want a set-it-and-forget-it portfolio with SCHD as the dividend anchor. If you're focused on rising income to stay ahead of inflation and want something durable through market cycles, DGRO is a smart fit. And if you're also thinking about leaving something meaningful for your children, growing dividends can become a lasting legacy. You don't need to time the market or guess the next big winner. Just start with a simple 50-50 allocation between SCHD and the ETF that fits your needs best. The right pairing turns SCHD from just safe into a strategy that works for you, your goals, your timeline, your life. And in the long run, that upgrade could be worth more than just higher returns. It could buy you freedom. If this helped you rethink your ETF strategy, don't stop here. Tap the video on your screen now to see exactly how much SCHD you'd need to retire and how long it might take. And if you want more breakdowns like this, hit subscribe.